I'm Andy Sams, I'm a partner here at Hundle and lead the wealth structuring side of our business. A separately managed account, or SMA, is where a client has direct underlying assets that are in their portfolio. So maybe it's helpful to compare that to what else is available in the market. What you might see with some places is something called a model portfolio. In a model portfolio, clients will all have the same underlying assets to the same degree. Similarly, in funds, investors in funds, clients in funds will have exposure to the same underlying assets as each other. An SMA is different in that every client has their own customised portfolio. So it allows for greater tailoring, greater control, and something that's much more specific to each individual client. There are four main tax benefits. One is around the timing of disposal of assets. Two is around tax loss harvesting. Three is to do with the profile of the underlying assets. And four is around how you can choose to delineate how your return is provided by way of capital return or by way of income. Timing of asset disposals, there are 2 points here really. One is around being able to time when gains are realised so that you can realise them as efficiently for you as possible. For example, by realising enough of a gain that you reach your annual exempt amount, which is an amount that is not subject to capital gains tax. So you can profile that every year, realise gains but not suffer capital gains tax on them. Another is around your individual tax residence. So for example, you could realise an asset whilst a non-UK tax resident, and assuming you meet various other criteria, that could mean you would suffer no UK tax on those gains. There's a bit of a word of warning there, just to be clear where you are tax resident and what the local jurisdiction tax treatment may be for you. Tax loss harvesting, simply put, is disposing of assets that are standing at a loss. So for most assets, that would give rise to something called a capital loss. Capital losses can be offset against capital gains, thereby reducing the amount of capital gains tax you might otherwise pay. What this allows you to do is, assuming the investment thesis stacks up, dispose of assets standing at a loss, realise those capital losses and offset them against capital gains that have already crystallised in the year. Tax profile of investments is something that particularly applies for separately managed accounts. So you can invest on an asset by asset basis. What that means is for each asset you can make a decision, how do you hold that asset? It could mean that you invest via a structure that better suits your family objectives, investment objectives, or your tax profile. It could also mean that you look at how that asset is invested through an existing structure, making sure that you use all claims available to you, such as things like claims under double tax treaties to reduce withholding tax through the structure. This is important as it can massively erode investment return without making such beneficial claims. What we mean by income versus capital gains is that separately managed accounts allow you to make a decision which assets you invest in. For some clients, the investment thesis may stack up, but they don't need an ongoing income. As such, they might want to invest in assets that provide their return only on disposal, so there's capital appreciation. And that capital appreciation is treated as a capital gain on the eventual disposal of the asset. For clients, that can mean that they're paying tax only at one point in time and at lower capital gains tax rates rather than income tax rates. Some of the investment benefits include full customisation and control for clients. So they can make decisions with their advisors as to which assets they would like to invest in on an asset by asset basis, rather than passively being involved in wider model portfolios or fund structures where there is less control and less ability to customise. Other benefits include things like being able to access a wider universe of investments. So you can have a portfolio that includes both liquid investments, but also some illiquid investments like direct equity or private credit investments that are held. So it gives a broader portfolio that might be more well-rounded and suited to that client. I think there's also a point here around reporting and transparency. So SMAs typically will report on all of the underlying assets that are held by the client. So they have full transparency. What do they hold? How are they valued? What is the income and what are the gains positions across all of those assets? Rather than sometimes that being lost if it's held through a fund structure. If you'd like to find out more, please click the link below or get in touch with any one of our team members. Full details available on our website, hundle.co.